Hello everyone. Welcome to our channel again. In today's video we are to be talking about how to understanding the contrast between stocks and bonds. Investing can be a daunting task, especially when you're starting out. With so many options available, it's easy to feel overwhelmed and unsure of where to start. One of the most fundamental decisions you'll need to make is whether you want to invest in stocks or bonds. While both can be profitable, they have different risks and rewards. Stocks are ownership shares in a company, whereas bonds are essentially loans to companies or governments. Introduction to investing: stocks versus bonds. When it comes to investing, one of the fundamental decisions investors face is choosing between stocks and bonds. Both stocks and bonds are popular investment options, each with its own characteristics, risks, and potential returns. Understanding the key differences between these two asset classes is essential for making informed investment decisions and building a well-rounded investment portfolio. Stocks, also known as equities, represent ownership in a company. When you buy stocks, you are buying a share of the company's ownership, and you become a shareholder. As a shareholder, you have the potential to benefit from the company's growth and profitability through capital appreciation and dividends. However, stocks are considered riskier investments compared to bonds, as their value can fluctuate significantly in response to market conditions and company performance. 1. What are stocks and how do they work? Stocks are a key component of the financial markets and play a crucial role in investment portfolios worldwide. When you buy a stock, you are essentially purchasing a small ownership stake in a company. This ownership stake represents your share of the company's assets and earnings. Capital appreciation occurs when the stock price increases, allowing investors to sell their shares at a higher price than they initially paid. On the other hand, dividends are periodic payments made by companies to their shareholders as a share of profits. 2. Understanding bonds and their role in investment portfolios. Bonds play a crucial role in investment portfolios, offering a different risk-return profile compared to stocks. Essentially, bonds are debt securities issued by governments, municipalities, or corporations to raise capital. When an investor purchases a bond, they are essentially lending money to the bond issuer in exchange for regular interest payments and the eventual return of the principal amount at maturity. Moreover, bonds offer diversification benefits to an investment portfolio. By including bonds alongside stocks, investors can reduce overall portfolio risk due to the low correlation between bond and stock returns. This can help cushion the impact of market downturns and provide a more balanced risk-reward profile for the portfolio. Bonds offer stability, income, and diversification benefits that can enhance the overall risk-adjusted returns of a portfolio when used effectively. 3. Risk and return: contrasting stocks and bonds. When it comes to investing, understanding the relationship between risk and return is crucial. Stocks and bonds represent two distinct asset classes that vary significantly in terms of risk and potential return on investment. On the other hand, bonds are debt securities issued by governments, municipalities, or corporations. When you invest in bonds, you are essentially lending money to the issuer in exchange for periodic interest payments and the return of the principal amount at maturity. Bonds are generally considered less risky than stocks, offering a more stable income stream and lower volatility. However, the potential returns from bonds are usually lower compared to stocks. In summary, stocks have the potential to generate higher returns over the long term but come with greater risk and volatility. Bonds, on the other hand, offer more stability and income but lower returns. By understanding the risk-return trade-off between stocks and bonds, investors can make informed decisions to create a well-balanced investment portfolio that aligns with their financial goals and risk tolerance. 4. Factors to consider when deciding between stocks and bonds. When deciding between investing in stocks and bonds, there are several crucial factors to consider that can help you make an informed decision tailored to your financial goals and risk tolerance. Firstly, it's important to assess your risk appetite. Stocks are generally considered riskier investments compared to bonds, as their value can fluctuate more significantly in the short term. On the other hand, bonds are typically more conservative investments with lower potential returns but offer more stability. Lastly, it's essential to diversify your investment portfolio to mitigate risk and maximize returns. By spreading your investments across different asset classes, including stocks and bonds, you can reduce the impact of market fluctuations on your overall portfolio. Consider your financial goals, risk tolerance, and investment horizon when determining the optimal mix of stocks and bonds that align with your investment strategy. 5. Diversification: how stocks and bonds complement each other. Diversification is a key strategy in investment planning, and it plays a crucial role in balancing risk and return in a portfolio. When it comes to diversifying between stocks and bonds, each asset class offers unique characteristics that can complement each other effectively. Stocks and bonds often have an inverse correlation in terms of performance. This means that when stock prices are declining, bond prices may rise and vice versa. This dynamic can help reduce overall portfolio volatility and provide some level of stability during market fluctuations. In conclusion, diversification through a mix of stocks and bonds can provide investors with a well-rounded portfolio that balances risk and return, offering stability and growth potential in various market conditions. 6. Strategies for balancing a portfolio with stocks and bonds. Balancing a portfolio with stocks and bonds is a key strategy in investment management. Stocks are known for their potential high returns but also come with higher risk and volatility. On the other hand, bonds are considered safer investments with more stable returns but typically offer lower potential for growth. Another strategy is to periodically rebalance your portfolio to maintain your desired asset allocation. This involves selling assets that have performed well and buying assets that have underperformed to bring your portfolio back to its target allocation. Ultimately, the key to successfully balancing a portfolio with stocks and bonds is to have a clear investment plan tailored to your individual financial situation and goals. By diversifying your investments across different asset classes, you can help manage risk and potentially maximize returns over the long term. We hope this our video on navigating investments and understanding the contrast between stocks and bonds has provided you with valuable insights into the world of investing. Thank you for joining us on this investment journey, and may your financial future be prosperous and secure. Kindly comment, share, like, and don't forget to subscribe to this channel.